Now that's how you sell a house. Anybody who watches my channel regularly might remember this house from a few months ago that almost burned down here in Surfside, and they put it up for sale back in November for $1.3 million, dropped the price to $1.2. Now they got a contract. So that's how you sell a house, guys. You make sure that it's halfway burnt to the crisp and it's priced at $1.2 million. And I guess that's probably a good deal for the neighborhood in the sense that you got a lot of comps around here that sell for, you know, $1.5 million and up, similar houses to this one. And so maybe that's why somebody bought it, because they figure, well, I can sink a couple $100,000 into it and, you know, we'll remodel it and bring it back to its original glory, and we'll be right at fair market value for what other people are paying around here. So I don't know. Let me know. Would you guys spend that much money on a burnt out house? $1.2 million, okay, for a piece of bacon. But anyhow, I think today is going to be some good news for a lot of you out there, and probably music to many of your ears, because there was a story today about how a big institutional investor, Apple's Way Investment Group, and they just lost a bunch of property in Houston, Texas to foreclosure. And we'll get into why this happened in just a minute. But right away, guys, is telling you things are finally starting to turn around, and people who thought that they could just buy up all this real estate and keep pushing prices up forever, that's coming to an end. And stories like this are now proof that those days are over. So this company, Apple's Way, they borrowed $230 million to buy buildings that have about 3,200 units in Texas. Now the mortgage company, Arbor Realty Trust, they were the ones who held the mortgage of these properties, and they foreclosed on these properties after Apple Way defaulted on the loan. And it turns out that the mortgage company has already sold the foreclosed units to a New York-based investment firm called Fundamental Partners, and it was for an undisclosed amount. So, of course, they're not going to tell you, right? But I'm sure it was less than the $230 million that Apple Way originally invested. So let's think about this for a minute. Why would a company like Apple Way not pay the mortgage on these 3,200 units that they bought? These are all multifamily buildings, and multifamily is typically one of the best and safest investments when it comes to real estate. So how did they end up losing on this? What went wrong? How did they get in trouble to the point where they can't pay the bills? Now, it doesn't really say in the story how this happened, but my guess is they probably paid too much for the property, okay, $230 million, and thought that they could raise the rents to the point where they could make it profitable. And it turns out they probably weren't able to raise the rents enough to where they needed the rents to be to actually turn a profit, and therefore had no choice but to default on the loans. That's just my guess at what happened. And like we talked about last week, the multifamily buildings have actually declined in value about 20% since the housing market started falling apart, which is kind of a surprise considering these are properties that mainly investors buy. But here's the deal. People just pushed up the prices too much on these properties. Too many of them were flipped for the higher price, and you have the greater fool theory at play here. Which investment group is going to pick up these properties and pay the most top dollar in order to see who can win this race in the real estate game? And it turns out that Apple's Way is probably the bag holder here. And here's what one of the chief executives over at Apple's Way had to say about this when they bought this property. They could double their investors' money by sprucing up lower income apartment complexes located outside of Houston, Texas, with a plan to raise rents and charge tenants extra fees for amenities. So that seems to be the blueprint of what a lot of these institutional investors would like to do. The only problem is you can't raise the rents, people can't afford to pay. And that's likely what happened here. On top of all of that, here's the other thing to realize. A lot of these big institutional investors, when they finance one of these deals, they get a floating rate debt similar to an adjustable rate mortgage, but it's actually worse because it can change at any moment. More like a home equity line of credit is similar to the type of funding that these big time investors use to buy properties like this. and it's great for them when interest rates are low, but now that interest rates have shot up, it's not so great. So it also increases their monthly debt obligation on these properties. And here's an example of this from Apple's Way. They had one loan that started off at 3.4% when the rates were low, and then ballooned to 8%. And it's not just Apple's Way that's in trouble, who's defaulting on their loans right now. In fact, there's another company called Veritas. They're out of San Francisco. They're a private equity firm, and they just recently defaulted on a $450 million loan that's backed by a rent-controlled apartment building, and now Blackstone's trying to get on the action and buy this one. So as you can see, these buildings are still trading hands from one investment company to the other, and you know, whoever's taking them on now at this point are the ones getting the better deals probably than the people before. Now, supposedly foreclosures like this one are rare, but as more of these loans have their interest rates hiked and more of these loans come due, and on top of that, the contracts that protect these big institutional firms expire, you're probably going to see more foreclosures like this, and these are big foreclosures. Now, is that going to be an opportunity for somebody like you and me to go out there and buy one of these 3,200 unit buildings? Probably not, right? But it's just another way to show that cracks are starting to form in the housing market and the economy. In fact, a record $151.8 billion in US mortgages that are backed by rental apartment buildings are set to expire this year, and $940 billion are set to expire over the next 5 years. So if interest rates remain higher within the next few years, you're likely to see more and more of these type of foreclosures. And remember, guys, this affects the banks too, because the banks get hurt with these type of foreclosures. We already saw the bank failures and the credit crunch starting to happen right now with commercial lending. So this is likely to make that even worse as more banks get slapped with these foreclosures. They're going to be even less likely to lend out money to other big companies to buy these type of properties in the future, which ultimately has a slowing down effect on the economy. Now this one here is actually selling pretty quick. They listed it back in February for $1,425,000, dropped the price about a month later, 100 grand, and a month after that they got a contract. So as you can see, people are still willing to pay the $1.3, $1.4 million mark for these small little houses here in Surfside, because they're walking distance to the beach and some of the things here in town. And just back in 2017, which really wasn't that long ago, this same house sold for only $630,000. And speaking of a slowing economy, I saw an interesting story today about the job market, talking about which industries are safe right now, supposedly, and which ones probably aren't so safe. And no big surprise, the #1 industry on the chopping block right now is tech, or they call it information services. And next down the list is transportation and warehousing. And the third one is construction. And I find those second two very fascinating for a couple of different reasons, because we need transportation and warehousing no matter what to keep things going, right? In order to keep products moving around the country, in order to keep the store shelves full, all of that, we need transportation and warehousing. But yet you're more likely to see layoffs in these industries coming this year than other industries. Supposedly, the risk of layoff with this is calculated by several different things. It's exposure to labor shortages, sensitivity to monetary policy, job function and education levels required, the state of its pandemic recovery, longer-term trends in labor demand, and the age, composition, and experience levels of its workforce. So I guess they're using a lot of complicated factors here to determine who's more likely to get the boot right now. And supposedly the tech companies are the highest on the list because this sector is the one that blew up the most during the pandemic and during the ultra low interest rates, because many of these tech companies thrive on low interest rates, and so they just hired way too many people, and now that things are starting to correct, they have to get rid of a lot of these people. But they're saying a lot of these people that are getting laid off in the tech world are not reflected in the unemployment numbers, because usually they'll lose their job and get rehired in another sector pretty quickly. And one of the most common ones that they'll transition to is healthcare, believe it or not, because, you know, hospitals and doctors' offices and all this need IT people as well. Now, supposedly the risks for warehousing and transportation and construction are because of slowing down of consumer spending. People are shopping less and buying less due to high inflation, as well as looming layoffs for many different people. And so people are starting to crack down on their budgets, whether out of choice or necessity. Either way, it's happening because people need to be more careful of where they put their money right now. Now, here's the industries that are totally on the opposite side of this. They have the lowest risk of layoffs right now. And reading this number one thing is just sickening to me, guys, and it's government, okay? Government, lowest risk of layoffs, you know, love them or hate them. You know, these guys, I guess, secure their own future off of the backs of people that don't have any security, which is unfortunate for everyone that's not in the government, but that's the way it goes. And beyond that is private education services, healthcare, and accommodation and food services. Now, the rest of that makes a lot of sense. You know, people need someone to take care of them when they're sick. We need hospitals and doctors and nurses, and people like that are always going to be in demand no matter what's going on. And supposedly the reason why accommodation, which is basically the same as hospitality, is not worried about layoffs right now is because they're still recovering from the pandemic. They had to let go of so many people during this time. They're still struggling to find people to work to this day. So just like the housing market is kind of booming still in some areas and crashing in other areas, the labor market is kind of similar in a sense that some people are just getting hammered and there's layoffs left and right in some industries. In other ones, they still can't find enough help. I think when you look at this, it's pretty safe to say that the reason that jobs like this can't find enough help is probably because not enough people want to do them for the amount of money that's being offered. And it turns out that HR recruiters, people that do all the hiring at these companies, 1 in 5 of them are actually pretty concerned about their workforce leaving because it's very difficult to even hire people to begin with, and it's even more difficult to keep people when it comes to retention because they need to make sure their workers are happy, they're feeling validated, and they are feeling like they're getting something out of this job. I mean, I remember so many times, basically every job I've ever had, guys, I mean, it felt worthless. It felt like, you know, beyond the few dollars I'm making off of this, like, there's no incentive for me to do this. You know, you don't feel like a part of the team or respected at the company or anything like that. You're just another cog in the wheel to keep things moving, you know what I mean? Now, all the news stories are saying how this is good news, that inflation now is down to 5%, and it was 6% before, so it's heading in the right direction. It's going down, which I agree, it is going in the right direction, if any of this is actually true. But like I told you guys, I feel like things are more expensive than ever. I just went grocery shopping the other day, bought less food than usual, and had to pay more. And I'm starting to notice more of a markup on little things that didn't really have a markup before. And, you know, it all adds up in the end. But they're saying that inflation for food and gas is down. So, I don't know. When I read reports like this, I just believe what I see in the real world. I don't really care what they say in the news or the reports because, you know, when I see the bill at the checkout counter, I know that this isn't true. And remember, guys, this is a year-over-year number, just like the housing market. So inflation is at 5% now, which is lower than it was previously year-over-year, okay? But it's still actually up a little bit month over month, which is kind of fascinating. It's up 0.1%, so not a lot, but still up nonetheless. And also you have to take into consideration this. When you hear these numbers about inflation going down, what they're really saying is that the rate of inflation is slowing down. It's not that things are getting cheaper, okay? That's the other misconception about these inflation reports is, oh, it's down to 5% now. Well, that means it's still 5% more expensive, everything in this overall inflation report than it was 1 year ago, instead of 6% more expensive. So this doesn't mean that things are cheaper now. It just means they're not going up in price as fast anymore. And even when they exclude food and energy from their inflation report, from February to March, the core inflation numbers are still up 0.4%, guys. And this is why I'm so concerned about what the Fed is going to do, because there's a lot of talk about them maybe doing one more interest rate hike in May and then potentially pivoting at some point after that and starting to lower rates again. And just imagine what that's going to do to inflation, guys, because you see how expensive everything is still when it comes to cars, houses, fuel, food, utilities, you name it. Everything costs way more than it did before they printed all this money, right? Well, if they start reversing rates anytime soon, I'm saying even within the next year or two, imagine how much more expensive things are going to get from there. Now here's something interesting. This house is a rental and they originally listed it back in mid-February for almost $7,000. Now they've cut the price down to basically $6,000 and still no renter. And the reason why this is interesting is because if we go back to the previous house as an example of one for sale, it would cost close to $10,000 a month to own that house with taxes and insurance, as you can see on my calculator here, but yet no one's willing to rent this house that's basically pretty similar to the other one for almost half the price. So as of right now, the Fed is saying that they're going to raise the rates probably again in May and then leave the rates there throughout the rest of the year, at least, before even thinking about a pivot, which I guess is better than pivoting sooner than that, but I still almost consider that a pivot, in my opinion, because what I think we've seen is that the rates really haven't gone high enough to cause enough unemployment, to cause enough for home prices to come down, prices and spending on everything to really come down. And we still haven't even really seen how much all of the lending pullback from the banks is going to have an effect on the economy. So when you have this environment where banks are going to be tightening credit, they're even saying they're going to do this, it's not a big secret, and the Fed pausing their interest rate hikes, it's kind of creating a condition where no one really knows what's going to happen. Obviously, the Fed is in the driver's seat with everything, and whatever they do dictates everything. But these guys aren't exactly known for making all the right choices at the right time, and that's kind of the big concern if you ask me right now. You guys see how high up this water is? It's probably only less than a foot away from this seawall. I'll bet when it was pouring rain the other day, it was practically washing over here. Living on the water has its consequences. But even the futures traders believe that the Fed is going to raise rates again in May, at least a quarter of a point. And the betting markets are saying this is what's going to happen. I too think that they're going to do this. And if you ask me, it should be by more. A quarter point doesn't seem to be really doing much, you know? That's my argument with all of this. Okay, they've raised rates, but like I said, guys, it hasn't been enough to really cool things off to the level that we need to. It's like they're afraid to cause the type of recession that we need in order to make things move forward again. And it's sad because we're all hanging in the mercy of all of this and trying to figure out what's the best thing to do with our money, whether it's a good time to buy a home or rent or whatever. And when you don't know what's going to happen with these major policy decisions, it makes it almost impossible to make the right choice. And like we saw earlier, that government is basically the most secure form of a job that anyone can have. Well, to me, that just means that these guys are all looking out for themselves because, you know, the Fed knows well in advance of the meeting probably what they're going to do, and they can make their own investment decisions accordingly to what they're going to do. But the rest of us are all left in the dark with all of this until the decision's been made. But anyways, this is what we have to deal with. You know, we don't have a choice in the matter. These guys control everything. They're controlling our financial lives, and all we can do is play along. You know, that's why I tell people, and I accept the gold sponsorships, because I buy gold and silver myself, and I tell people, listen, you can secure your own wealth. And this video is not sponsored, okay? I'm just telling you that it's something that I believe in, and you can have sort of like an insurance policy against what the Fed is going to do, because gold and silver is something that the Fed cannot print. So never forget that, okay? Our entire money supply is manipulated by the Fed, but they cannot manipulate gold and silver. They can't pull more of it out of the ground on demand like they can with dollars. And that's why I think everybody should own at least some. You know, I'm not saying to put your life savings into it, but the traditional advice with owning gold and silver has always been to keep roughly 10% of your wealth or your portfolio in it, so that way you have a section of your wealth that's protected against things like inflation and money printing, which I think is smart. But hey, you guys can do whatever you want. You know, you don't like gold and silver? Fine, don't buy it. Go buy Bitcoin or NFTs or the latest, you know, FTX coin or whatever you want to invest your money in, all right? You don't have to listen to me, but I just want to share my opinion on things and what I believe to be a good way to preserve wealth. We all have our opinions, guys. Sometimes we might not always agree, but there's nothing wrong with having a little bit of disagreement and seeing people's opinions from different points of view. If you enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I post a new video, and if you don't want to wait, check out my next one on the screen right over here, and I'll see you in the next one.